transparent, to treat them more like actual financial institutions. But
with an estate freeze, the timing is important. This client actually said to me a few years later, you know, I wish I'd waited. I wish I'd waited 5 or 10 years. And he was thinking this not because of any tax planning. He just, his sons, he has 2 sons, were relatively young at the time the trust was set up. And it's the trust's 21st birthday that's important here. And at which time his sons were kind of in their late 20s. It would have been better, my client thought, from a business succession standpoint, who's going to run the business, if there was more, if the sons had more experience. And the decision of the trustees is how much to each beneficiary. So, for example, as between the sons and other beneficiaries of the trust, which included his wife and himself. That decision he felt kind of rushed on, even though it was 21 years after the creation of the trust. He would have liked to have had maybe 5 more years. In that case, he wouldn't have been able to freeze at $20 million. He'd have had to freeze at whatever the value was 5 years hence, which might have been $25 or $30 million. But still, as it turns out, a much smaller amount than the value at the time of 21 years anniversary, which is more like 500 million. So you're explaining to your client about how an estate freeze works, or any other reason for which you want to create a holding company. And the client says, well, do I actually need the holding company? What if my situation were simpler and my objectives are simpler? So this person owns all the shares of a corporation, and she wants to do an estate freeze. And she knows who she wants to get the common shares, and there's no need for a trust. She's more than happy if the shares are taken up by a combination of children and spouse and employees, et cetera, and she knows sort of what the proportion should be. And in that case, there's honestly no need for a trust. What she would like to do is just to swap her common shares for preferred shares. This solid line is the line I use for commons, and this denotes preferred shares, so a broken line preferred shares. So essentially what she wants to do is change her commons into preferreds. No holding company, same company, just one company. And then issue new commons to these folks in whatever proportion she decides she wants to issue them in. Can she do this? And the answer is yes. What allows her to do this is Section 86 of the Income Tax Act. Please turn there. What's a reorganization of capital? Well, the way the Income Tax Act sort of thinks of it is, as in this situation here, we had a shareholder had shares of one class of shares, common shares, and she's exchanging her shares for shares of a different class, and the Income Tax Act says that's okay, let's call that a reorganization of capital. Where at a particular time, in the course of a reorganization of the capital, a taxpayer has disposed of capital property that was all the shares of a particular class of shares that were owned by that person. And properties receivable from the corporation that include shares of the capital stock of the other corporation. So in this case, she's exchanged her common shares and got preferred shares. At today's value, because it's a Section 69 transaction, not arm's length, the following rules apply. The cost to the taxpayer of any boot is deemed to be the fair market value at the time of disposition, so says A. More importantly, the cost to the taxpayer of any new shares of any class of the corporation, the preferreds, shall be deemed to be the proportion of the amount. Let's say this is 100%. The totally adjusted cost basis of the old shares exceeds the fair market value of boot, none in this case. So basically what this does is says, okay, look, she had adjusted cost base in these shares of, let's say, $100 in the common shares. Her adjusted cost base of her new preferred shares is also $100. That's what B does. And C, and this is the important one, she's deemed to have disposed of the old shares for proceeds of disposition equal to the cost of the new shares. So her adjusted cost base of the new shares, $100. She's deemed to have disposed of her old shares, the commons, for $100. No capital gain. Totally okay. Much simpler than having a holding company if she doesn't want one, and she can create one later if she wants. And she might want, because there are now more than one shareholder and more than one class of shares, the timing of dividends might be more advantageous to one shareholder versus another. Thus, there might be actually a need down the road for a holding company, but at least at this moment there's not. She just wants to keep the same corporation, and 86 provides that.
So with 86C, it says that preventing a capital gain. Could you try to make the transaction to a capital loss?
No. It's just like 85, there's another clause or another paragraph here that says no capital loss. Okay so far? Let's say that the adjusted cost base of the shares, her old shares, is a higher amount. Let's say it's $100,000. She says, I kind of like this Section 86 idea, which means no holding company, but I want to take out boot. Can I do this? And the answer is yes. We can make this into the type of transaction we spoke about earlier for Section 85, where we take out boot up to the amount of the adjusted cost base, which therefore reduces, as it should, the adjusted cost base and the PUC of her new preferred shares. These people off to the side, they come in for $100 a piece or $10 or $1,000 or whatever, just as they would have if there was a Section 85 transaction and they were shareholders in the holdco. Section 86, nice that it's there. Honestly, I like having a holding company because there are so many things I can do with it, like for example, have more control over the timing of dividends taxed personally, but certainly understand if your client wants to use a simpler structure, this is what provides it, and this does allow pulling out boot up to the amount of the adjusted cost base. actually up to the amount of the paid-up capital of the old shares.
I have a question. Does that also work if those shares have voting rights as well?
So the old common shares obviously were voting. The corporation, or she and the corporation, decides what the voting rights of the new preferred shares would be. And again, as in the previous case, she probably wants these shares to way outvote these shares, which she can do either by a zillion votes per share or a zillion shares to outvote what these folks have. Please turn in the textbook to page 563. So we're going to get a little deeper now into reorganizations. I would call a Section 85 rollover reorganization. We've transferred assets, we've messed with the shares. Section 86 by name is a reorganization. Section 87 covers amalgamations, which I would say is another type of organization. And there are essentially two types of amalgamations. And they both depend on what the before picture looks like. So in the first case here, the before picture is two corporations, one owns the other. We call that a vertical amalgamation. We're going to combine those two. Next page. Two corporations either owned by the same person, shareholder X, or maybe one is owned by shareholder X and one is owned by shareholder Y. But one corporation doesn't own the other corporation. We call this a horizontal amalgamation. In both cases, tax-free transaction all around, no capital gain in any of the shares, and no capital gain or deemed disposition as regards the assets of the corporation. So we have two corporations, stock full of assets, like maybe there's capital assets and inventory and businesses and you name it. A whole bunch of assets that we don't want to have any capital gain or recapture. Section 87 provides us a rollover, just like Section 85 and Section 86. In this case, Section 87 is the one that provides it on amalgamation. So the new company simply picks up the assets and liabilities of the old, and all the tax values carry forward from the predecessor corporations. Section 87, please. Uses the word merger. I don't think the word merger is defined in the Act. I'm guessing that it's a word that's probably a creature of either provincial or federal corporations law. You'd know better than I. But essentially what's happening here is we have two corporations becoming one, either in a vertical sense or a horizontal sense. And every other rule, including A through C, which I will ask you to read after class, says to us, there's a whole whack of capital gains potentially here. We're not having a capital gain on anything. As a shareholder, my old ACB and my new ACB are the same. I got no capital gain. The corporation itself, the corporation's tax values, all transferred to the new corporation. There is a deemed disposition, a deemed year end that occurs immediately before the amalgamation. So today is March 3rd, I think. If the two companies current taxation year started on January 1st, both companies have a deemed year end as of March 3. They have to file a tax return covering, I guess, 2 months and 3 days. And that's more honestly the purview of accountants. Interestingly, this is more the purview of lawyers. The new corporation can start its new year end on March 4th and pick any year that it wants, as long as it's within 53 weeks of March 4th. So maybe the predecessor corporations one had an October year end, one had a September year end. The new corporation can create any month end or any year end it wants, which doesn't have to be one of the year ends of the predecessor corporation.
I have a question. Does that stub year have its own, that stub year will have its own independent calculation for losses and gains and revenue, right?
Of everything. Expenses including capital cost allowance, you name it, all of which are prorated or otherwise just whatever 63 days of income are.
So you could stuff a whole bunch of stuff in there without having to, you could sort of be the closet and just sort of throw all the extra stuff in there.
Tell me more.
Well, if you have a year end where you have employees to pay because you're doing an amalgamation, you can throw a bunch of, you could throw a bunch of income and stuff into a stub year where it's a lot smaller, and you've got, right, because you can play around with which tax year you have your revenue coming in, because on the calendar it's possible that you could have, in one calendar year, you could have 3 corporate years. At the end of the pre-merger, you got the stub year, and then the beginning of the new corporate year, all in one calendar year, right? So you have condensed timelines, so.
I don't think it works out that you are weighting the stub period differently from other years. I mean, many corporations earn their income in a lumpy way. So for example, retail companies do really well in the fall and sometimes lose money at other times of year. Fall being closer, like pre-holiday season. It's possible that having an amalgamation of a retail company, say in March, produces a loss, not due to any tax planning or anything like that, but just the way it turns out. I guess we do have the ability to, for example, pay bonuses and stuff like that. If we want to reduce our taxable income, keep in mind that our $500,000 small business deduction gets prorated by 63 days over 365. So some of that comes into play here. I can't think of any awesome ways by which we can do something to benefit us as regards the fact that we have a stub period. One key difference between vertical and horizontal is as follows. Say we got 2 corporations owned by 2 individuals. We amalgamate them, and from now on when I do this big box, that means we're amalgamating. And now this person is a shareholder of the amalgamated company, and this person also a shareholder of the amalgamated company. This person's adjusted cost base in this company, adjusted cost base and paid up capital is 10. And so is this person's adjusted cost base and paid up capital in the amalgamated company. And same. So whatever our PUC and our adjusted cost base were in each of our companies carries forward to the new company. Kind of like common sense, but you actually it needs to say that someplace in the Income Tax Act, and it says it in Section 87. So that's pretty straightforward and a common sense deal as regards horizontal. Watch this. Vertical, let's say this is 10 and 10, adjusted cost base and puck. Let's say this is $1 million and $1 million. That is the adjusted cost base and puck that this company has in these shares. And then we amalgamate these two. God. The only adjusted cost base and puck that survive, because this is the only shareholder and it only now has an interest in this Amalco that replaces this person's interest in that company. Well, this person didn't have an interest in this company. They only had an interest in that company. Thus, the only adjusted cost base and puck that this person can hope to have survive this transaction is this. The $1 million? God. Special thing that applies on a vertical transaction. It just does. Horizontal is different, sort of additive. You add the two, away we go. Vertical, whatever tax value we have in this bottom company, disappears. Now, let's say that these shares are worth $10 million. And there is a piece of land inside this bottom company that's worth $10 million. We're going to amalgamate these two. So fair market value, adjusted cost base, puck. What's going to happen is that this land is going to be in the amalgamated company. So right now it's in the bottom company, but when we amalgamate the two, that is merge them, the land will be owned by the amalgamated company. So at the end of the day, it's going to look like this. So the land will be inside the amalgamated company. We have, if we prepare an election that is advised CRA in writing that we want to do something, the opportunity to step up the cost base of this land from whatever it was, let's say it's $100,000, up to our so-called outside basis, that is the ACB that there was in this company. The ACB that there was in this bottom company, we can, which was owned by the holdco, we can take that ACB, whatever it is, and stick it onto the land that is now owned by the amalgamated company. Here I'd like to go to the textbook on page 564. And what this is called is a bump. A particular tax benefit may occur on a vertical amalgamation if the parent owns 100% of the subsidiary shares. The benefit results in an increase in the tax value of certain assets, referred to as a bump, when the parent's adjusted cost base of the subsidiary shares is greater than the sum of the tax values of the subsidiary's net assets, or at least no less, let's say. So let's say that the adjusted cost base in the shares was $1 million and the adjusted cost base that the bottom company had in the land was also $1 million. But now the value of the shares in the land is $10 million. So what happens is that we are able to use that $10 million, pardon me, the value of the, or the fair market, pardon me, the adjusted cost base of the shares and load that onto the land if the land's adjusted cost base is not as high as the adjusted cost base of the shares. Bottom of page 566, parent owned a bunch of shares, and in this regard, we're talking about a wind-up, which is similar to an amalgamation, and I'll explain the difference shortly, but trust me, the rules are the same. Acquired some shares for $700,000, and the fair market value of non-depreciable property land was $150,000. And I will tell you that this bump opportunity is only available in respect of non-depreciable property. There are only two types that I know of that are useful to do this with. One is land, which is our example, and one is shares of another company. All of our examples, including the exams, will be about land. The fair market value of the land was $180,000. So the land has gone up in value. It was $150,000 at the time the parent bought the shares of the subsidiary. Now it's gone up to $180,000. And now the subsidiary is being wound up into the parent, which is a similar transaction to amalgamation. These rules apply identically on winding ups and amalgamations. And what happens here is that the adjusted cost base of the land is going to go up, not because the parent bought the land at a high value, but because the parent bought the shares at a high value, the shares of the company that contained the land. Now, this calculation is written for accountants, and you don't need to know it. All you need to know is the principle that we can step up the adjusted cost base to the amalco of the land to compensate us for the loss of that adjusted cost base and PUC in the bottom company. So we shed a tier for the loss of the adjusted cost base in the PUC, but we look inside the company, the bottom company, for non-depreciable assets, land specifically, and we can use that ACB of the shares to increase our ACB of the land inside the amalco. Don't need you to know how to calculate it, just need you to know that there's an opportunity there for a step up in the cost base of the land inside the bottom company, and only the bottom company, using the ACB that we had in the bottom company to begin with, which ACB now disappears on an amalgamation or winding up.
So you don't need us to know how to calculate how much or what the amount that it bumps up by at all?
Just need you to know that the opportunity is there.
When you do a bump up, it only affects the properties. In this your example here, it only affects the properties of that land as an asset, not the shares that were issued to the shareholder at that point.
Only the land that is an asset was of the bottom company is now of the amalco.
Now, as part of the amalgamation, it would make sense that they would probably issue new shares as a separate transaction?
Nope. No need to. If they want it for other reasons, they can, but
So in this example, where you had a small amount of shares issued directly to the shareholder, there would just be a small amount of shares and a large amount of corporate assets?
Exactly.
Okay.
Which, if that makes you feel uncomfortable, you can do a stock split or something else to,
But there would be a lot more capital to back such a transaction in the future if the company, if that's what they wanted to do.
no more so than before.
Well,
Because,
the example you had before, the shareholder only had 10, right? Had an adjusted cost base and a pocket of 10. Whereas now you've now got $1 million piece of, a $10 million piece of land. So,
but don't forget that what you had before, so yeah, this is only 10, but what you had before was a $10 million corporation.
yeah, so you got rid of that, which was $10 million. So now you've got a $10 million piece of land sitting in an amalgamated corporation that has a $10 share issue.
Just how it works out.
And there's no problems with that, right? Like,
None.
okay.
I wonder what the paid-up capital of Berkshire Hathaway is.
Well, I'm just wondering, where does the paid-up capital go in that situation? Because there's a whole bunch of paid-up capital that's not designed by anybody.
It's gone.
It's just gone.
It's gone. The best I can do is load it onto non-depreciable property in the same company whose paid-up capital disappeared. That's the best I can do. And you say to yourself, well, hang on a second. What am I losing if the paid-up capital has disappeared? I mean, this was a corporation owned by a corporation. So for example, any share redemptions, and paid-up capital is only relevant on share redemptions. So any share redemption would not have caused a dividend to an individual. At worst, it might have caused Part 4 tax.
But in this case now, anytime anybody takes a dividend, they're now paying tax. Whereas there was basically $10 million of essential, at one point, tax-free money that is now being taxed again.
True enough. But if they want to, they can impose another holding company here.
But the shareholder could take it out completely tax-free. Right? If
But the shareholder doesn't own these shares.
the shareholder, well, okay, so the shareholder was the company. It was
Correct.
the company that could
Yeah,
take,
yeah,
okay,
yeah,
I see.
yeah.
Isn't it still better because the land is worth more, so there's no worry about with POC getting a deemed dividend? In this case, if they ever sell that land, you could get a capital dividend to the hold co, correct?
That's true, but you would have got a capital dividend anyway. In fact, you would have got a larger capital dividend before because you would have had a larger capital gain. Now we're going to have something better, which is less capital gain, thus less cash taxes to pay. And yeah, as a result, my capital dividend will be less, but fine. So again, what I'm doing is I'm taking adjusted cost base that I had, that the top company had and the bottom company, and I'm loading it onto non-depreciable capital property, i.e. land, previously owned by the bottom company, now owned by the amalgamated company. Vertical amalgamation, simply amalgamating these two companies. Winding up, something different. Winding up, also called dissolution. Have you taken corporations yet, spoken about dissolutions? Dissolution is a corporate law word. Winding up is a word that's actually used in the Income Tax Act. In this case, in Section 88. Section 84, share redemptions, 84.1. Sales which we hoped would be capital gain turn out to be deemed dividend. Section 85, transfers of property to corporation, tax-free basis. Section 86, reorganization of shares, thus negating need for holding company. Section 87, amalgamations. Section 88, windings up. So it's just this. The corporation disappears and all of its property becomes property of this corporation, which would normally, again, be a whole whack of deemed dividends and proceeds of disposition and recapture and capital gains. Section 88 says no, as long as this company owned 90% or greater of this company, of the bottom company, tax-free transaction. Interestingly, no deemed year-end of this company, deemed year-end of this one, which has now gone poof. No deemed year-end here. So this company doesn't have to worry about preparing a stub period financial statement, that type of thing. Lawyers generally prefer amalgamations because they are cleaner, use less paperwork. Articles of amalgamation is actually a form that's provided for in corporate legislation. It's easier to deal with because it's just a share transaction. A winding up involves a whole bunch of things like assets are being transferred, there might be some sales tax issues, liabilities are being assumed in ways that are more complicated than just smashing two corporations together. So amalgamations are actually more popular as far as corporate lawyers are concerned. The result, generally speaking, though, is the same result, that is no tax payable, no deemed dispositions. And again, if there was land down here, the ability to have the land come into the parent company, there is no Amalco, there's just the parent company left, on a bump, same way, in the same way as we spoke about for amalgamated corporations.
Is there a horizontal, so this only applies to vertical, not horizontal?
Correct, there is no such thing as a horizontal winding up, only vertical. Please turn to page 367 in the textbook. The most powerful thing you can do from a tax standpoint, tax planning standpoint, is probably an estate freeze for the reasons that I gave earlier. Because if the numbers are large enough, it's a very substantial deferral of tax, typically to the next generation. The second biggest is the capital gain deduction. Capital gain deduction says that if the company, for example, an operating company, let's say a manufacturer, owned by an individual, company that carries on an active business. The shareholder, the individual shareholder, can sell those shares and enjoy a capital gain of up to $866,000 tax-free. Let's say there's more than one shareholder. Each shareholder can enjoy a capital gain of $866,000 tax-free. So if this company is worth whatever 4 times $866,000 is, like $3.5 million bucks, sell the company, no tax to pay, even if the adjusted cost base is $1. Yes?
So when you say individuals, you're emphasizing that because you couldn't create multiple corporate shareholders.
Only individuals. Only individuals can use this. So for example, if I have a holding company and the holding company sells these shares, I'm out of luck. I cannot use this capital gain deduction. Turn to page 40. What this looks like on the tax return of an individual is we calculate net income, which would include taxable capital gains, including on this transaction. But the individual gets to claim a deduction to arrive at taxable income. In this case, there's an $866,000 capital gain, a $433,000 taxable capital gain, and a $433,000 capital gain deduction. The deduction itself is found in, please turn in the Income Tax Act to section 110.6. Bracket 2.1. And this is the key word. The key word is indeed individual. In computing the taxable income for taxation year of an individual. Only. Not a corporation, nor a trust. An individual. So the question is, what kind of companies qualify? Because if this is just an investment company that owns shares or something like that, that's not what this is for. What the government is trying to do here is to provide an incentive for people to start businesses, and then when they sell those businesses, assuming that the business is owned by a corporation, the government is happy if the person who started it, took the risk, et cetera, gets a large part of their ultimate return on it, the sale, tax-free. So no portfolio stock, no apartment buildings, et cetera. We're talking about active businesses here that probably involve things like manufacturing or technology or retail, et cetera. So an active business of some type, not a passive business that earns SIB income. Over the last 2 years before the transaction, so assume the transaction happens today, March 3rd, 2020. Looking backward over the last 2 years, at least 50% of the fair market value of the assets need to have been used in an active business. In Canada. So for example, if I've got expansion into the United States, I can only count my Canadian assets in this fair market value test. On the day, all or substantially all of the assets, which court cases have held to be 90% or greater, all or substantially all is referred to in the textbook and in the Income Tax Act, but isn't defined anywhere in the Act. Thank you, jurisprudence. It is 90% or greater of the fair market value of the assets have to be on that day used in an active business. So we might have a few bucks invested in term deposits or something, but 90% of the fair market value has to be represented by active business assets used in Canada. And getting back again to 2 years, over the past 2 years, the shares cannot have been held by an unrelated person. So I can't buy shares from you and then flip them within 2 years. I could buy shares from my brother, but not from an arm's length person. And it's honestly an anti-flip provision that wants me to have at least a 2-year holding period, or at least people related to me. Final point I want to make on this today is that the valuation, or the fair market value, includes whatever the appreciated value is of, for example, real estate. Let's say that this manufacturing business is inside a building. The building is worth a lot more than when we first bought it. It includes goodwill. Goodwill, you recall, is the value of intangibles like intellectual property and client lists, those types of things, the value of the brand. Those things aren't on the balance sheet of a corporation. Accounting rules don't count those things on the financial statements of a corporation. Therefore, somebody like an appraiser or perhaps accountants or others have to figure out what the value is of these assets to determine if the 90% test is met or not, and the 50% test. Where you come in as lawyers is to make sure that you're the quarterback that says, okay, who is it that's responsible for developing these values? We need these values because there's a lot of tax savings at stake. Somebody's got to figure out what the goodwill is worth, et cetera, et cetera. One place to find out is, well, how much is somebody going to buy the shares for? Let's say the shares are going to be bought for $10 million. We can take that $10 million and work backwards to find out how much the value of the assets are, and I'll show you how to do that in the next class.
My only question was, where's the onus to prove that this is the case? Is this the corporation that has to prove that, or is it something that the shareholder would be expected at some point?
Oh, it's on the shareholder because it is the shareholder who is taking advantage of 110.6 and getting the deduction.
So how is the shareholder supposed to prove, what the corporate assets are?
I'll show you that next time.
Okay.
There are safe and smart ways and simple ways to do that.
We need 3 entities.